Hey everyone, welcome back to part two. I'm here with Andrew Craig, and in part two we're going to be talking about buying stocks through the stock market, index fund ETF. We're going to cover that. We're going to cover off the very hot topic, which is meme stocks, those speculative, manipulated, big money earners but lose everything stocks as well. And then we're going to finish on gold and the importance, and is it still relevant and competing with everything else that is just media fueled at the moment. So Andrew, if you were to search on YouTube, at the moment most of the things comes up, how to invest in the stock market, earn millions in the stock market, it's everywhere. But how does someone actually start investing in the stock market and perhaps make a good, reasonable return? Where would you say to start?
So here comes the curmudgeonly old man. I mean, I said earlier I'm 45 years old. I'm going to sound like I'm 75 years old saying this. But I mean, so I think it goes back to a point I made earlier, which is that of investing versus trading. You know, you've got to decide which one you're doing, and we're more about investing than trading. I think you need to have quite a lot of money before you start trading. So that's buying something today, selling it tomorrow, or buying it today and selling it next week, or shorting, all this sort of stuff that you might do with spread betting or whatever else. That's really only appropriate if you've got a lot of money and a lot of time and a lot of knowledge. For investing, which hopefully still addresses your question, there are broadly two approaches. One is to use funds, so run by someone else. So where you basically pay a fund manager to decide on which specific companies to buy. And you can buy smaller companies funds, buy technology funds, or just broad funds that own lots of big famous companies. There's a lot of evidence that most fund managers underperform the index, i.e. just the stock market itself, which means that there's quite a heavy argument to just buy, like if you decide you're going to get into shares, you just buy the whole stock market. So in the UK, that's the FTSE, and in the US, it's the S&P, and in Japan, it's the Nikkei, and in Hong Kong, it's the Hang Seng, and it's the DAX in Germany, blah, blah, blah. And you can actually buy all of those discreetly as I want to buy German equities. It's probably easiest to buy British or American ones to keep it simple. So that's one way of doing it, through funds, either what are called active funds run by a fund manager, or passive funds, which is what I just said, where you just buy the stock market. Yeah. And for most people, that's probably the most appropriate thing to do. But if you want to get into single companies and think, I've come across a little tech company or an oil and gas company or a precious metals mining company or biotech or something that my mate has told me about that's really exciting and thinks is going to go up 10x, that's fine. As long as you make sure that you have done a lot of learning about how to value companies. Yeah. And you need to understand fundamental analysis, like what is a balance sheet, what are earnings multiples, how does growth in a company's earnings affect the valuation of that company potentially. And I would contend you need to do technical analysis as well, which the trading community love, which is what a chart looks like. Yeah. And if you find a company that is fundamentally really interesting and undervalued, like it's growing at 100% and it's quite cheap a share, and then technically it looks quite interesting as well, you've probably got quite a good chance of making money in that. But again, this comes back to my point, it's a lot of work to get to the point where you know how to do that.
So you've got to know the market before you invest, and it's attractive to a lot of people because the stock market is glamorized, it's very kind of like sexy if you're in the stock market. Would you say, there are different applications. I use Moneybox for a fund. I also use eToro for hand picking. I used to use Hargreaves and Lansdown. Yeah. For those that are looking to start, are there any platforms that you're aware of that are worth using application? Because everything is instant.
Well, again, it comes back to the difference. So there's a big difference between an investment platform, which gives you a range of funds, as well as stock market investment, and people like eToro or Trading 212 or DeGiro, all these sorts of ones, which just give you single stocks, shares. They're very different things structurally. And one is really the eToro or 212, Trading 212 are much more for trading and not so much for investment. So I think it's important to kind of pick your winners. The final thing I'll say about that though is, if you're going to go trading and use eToro or whatever, if you're really going to go down that rabbit hole and learn enough about it to do it well, I would personally, and you should never make this recommendation, subject to all sorts of caveats about it being appropriate, I would use a spread betting account. So somebody like IG Index, where you are basically making bets on the movements of assets. And if you're going to trade, that is an incredibly tax efficient, powerful way of doing it. Yeah. But again, with all the caveats around, that's risky and tricky.
Cool. So take note of that before you start trading and know the difference between the investment and the trading. So that's really key. So just to finish on, talking around the stock market, what's your sort of 30-second view of what you think that's going on with the meme stocks at the moment.
Look, I mean, genuinely,
Is it genuine? Can you make money? What's your...
I would avoid it like the plague.
Right.
It's pure gambling. Like, it really is, because when we were talking in the lift on the way up, like, you were talking about a mate who made 13 grand in such a stock the other day, and that's fine. And I mentioned the fact that one of the pieces I'm going to write in the next few weeks is going to be called "You Only Sing When You Win When You're Winning," because, like, okay, that's fine, but the next time the probability that you lose 13 grand is just as high. It really is. And it's the Warren Buffett thing about when the tide comes out. It's only when the tide comes out you see who's swimming without any trunks on. I mean, we are in a very nobody can see who's wearing no trunks environment at the moment, because the market just keeps going up and up and up and up. That doesn't last, and it pains me as a 45-year-old bloke who's been in the market for 22 years that I saw it in 99, 2000, I saw it in 07, 08, time and time again. Particularly young people don't learn it because they've not been through it before, and they just think, oh, it's easy to make money. My mate watched 3 TikTok videos and made 10,000% in crypto. That's fine until it isn't, and trust me, the "it isn't" bit is definitely coming at some point.
So I think the big moral of this story with meme stocks is that don't invest money that you need or you need to live off. It has to be dead money, has to be personal circumstance. And what we're going to do is, if you join us on part 3, we're going to talk kind of that Bitcoin, the crypto versus the gold. We're going to go into a few other subjects around pensions. So join us in part 3, where we're going to dive into some exciting topics.